is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance, Early Edition TV and Radio. I'm Danny Berger in London, standing in for Francine Lacqua. Here's what's coming up on today's program. Santa rally, U.S. stocks hit an all-time high on Omicron optimism that it won't hamper the recovery. Markets sit steady amid thin trading. The spike in COVID cases upends travel plans. United and Delta Airlines cancel around 200 Christmas Eve flights due to personnel shortages. Plus, gas prices plunge as more ships carrying U.S. LNG race to the continent to offset Russian supplies. Well, first, let's check in on markets an hour into the cash equity trading. I should point out we do see most European markets open. However, the DAX is not open. We'll ignore Boston housing on the bottom there. But we're looking at a Stocks Europe 600 that is dead on flat. We are looking at a FTSE 100 that's up 0.3%. Now, there's not a ton we can read into this, given that it is very light trading volumes today, and given the fact that just yesterday we had all-time highs on the U.S. market. Now, a lot of that holiday cheer was also brought on by the fact that we had a lot of U.S. economic data coming out yesterday. You had U.S. durable goods orders stronger than expected. You had consumer sentiment also strong, not really curbed by any of those Omicron fears. Yes, inflation was high. Yes, consumer spending was flat. But there's some optimism that we can indeed see through this period of a new variant. So now we have Brent crude here on the bottom. It is falling by about 1%. We also saw Asian stocks fall. So there are some tinges of risk off. But again, the caveat to all of this is trading is really light. Well, with that in mind, let's look at your screen. GMM Go on the terminal is where you find it. This is your global macro movers. And you do see some other tinges of risk off here as well. Now, where you can see that, things like the Canadian dollar, so those kind of commodity currencies, that's down 0.1%. You also see some of the various markets that are open. Russia is down. Another interesting one to take note of, again, Turkey is going to be open all day. We do have most markets closing early, but again, if you want to trade the Turkish markets, you can do that for normal trading hours. 2% gain for the Turkish stock market. The lira falling. It had been gaining every single day this week, the biggest gain since the 1980s after Erdogan stepped in, putting in controls for retail savers, trying to get them to continue to hold on to the lira, saying that the government would supplement any losses that they saw in their accounts due to fluctuations in the currency. Final asset I want to point out is over here in the commodities column, and it is natural gas. A third consecutive day of plunges, the biggest three-day plunge on record, down some 40% from the highs. That's because we're seeing LNG tankers attracted by the high prices in Europe, given there's the energy crunch going on, really attracted to those ships going over there. Now, let's continue with this market story, and traders brought their last-minute holiday cheer. The S&P 500 hit an all-time high amid optimism that economic growth will weather the Omicron coronavirus outbreak. Let's bring in Bloomberg's FX and rates team leader, Christine Aquino. Christine, how does this set us up for the so-called Santa Claus rally, the one that we usually see historically next week?
Yeah, well, it's going to be a very interesting setup for sure, Danny. I think, yeah, it's interesting how just trading this week has really evolved from starting very, very risk off at the start of this week and then gradually climbing down from that negative risk sentiment and then ending the year or rather ending the week on a record high, at least for U.S. stocks. And so I think that's really very much telling of just how easily sentiment at the moment in markets can turn depending on the headlines. I think we're very much into headline watching mode heading into next week. And so with that in mind, I think if we see more indications of essentially the Omicron situation being less severe or less negative than markets initially feared, then there's definitely a lot of room for a reversal in that risk-off tone, again, that we saw at the start of this week. And you definitely see some evidence of markets and traders just being willing to receive more good news on this front, especially because when they first kind of this got on the radar of markets, the Omicron variant, it was very much a mood of sell first and ask questions later. And so that leaves us a lot of room here to recoup some of that initial selling that we saw.
You know, it's been interesting because, yes, there's been that gut punch reaction to Omicron. But when we look at investor surveys, be it our very own MLive one, be it some of the Bank of America ones or otherwise, it continues to be inflation that is really brought up as the #1 concern. What does that mean in context, for example, of yesterday's PCE numbers when you have this really hot inflation readings that continue to come in?
Well, I think it is very much a reminder that we have all these big long-term economic factors to take a look at, especially heading into 2022, right? I mean, the Omicron risks are arguably something that kind of hit markets in the short term, but then there's so many big questions in the macro picture, and definitely inflation is front and center as one of them. And of course, this also ties in very well to some of the other surveys that we saw earlier this month, indicating that some of the biggest fears for markets heading into next year is very much a policy mistake, or the potential for a policy mistake. And of course, inflation plays very well into that sort of fear as well. And really, it's the idea that, are we going to see central banks hiking too much that it actually hurts growth in the long term, because they're very, very concerned about inflation? And how is that going to impact longer term growth prospects, and therefore longer term prospects for markets?
Christine, I do have to ask you about the one market that perhaps is having a little bit of excitement that isn't in that pre-Christmas slumber, and that's natural gas, down some nearly 20% today when it comes to Dutch front-month futures. When you look at a natural gas market that's extremely volatile, does that have any contagion effects, be it other commodity markets, or maybe just concern about what the crisis means for the European economy?
I think it's definitely the latter, especially when we got some of the surging energy prices earlier in the fourth quarter. It was definitely not great for sentiment, for sure, because it has very real world consequences. The idea that consumers are going to have to be shelling out so much to be paying for their gas at a time when they're vulnerable to cold weather wasn't necessarily great for sentiment. And so there's a little bit of relief, I can imagine, now that we're seeing a bit of a climb down in those prices. And yeah, I think there's going to be a lot of questions as well during the season over supply, and whether people who need to heat their homes for the winter season are going to be able to do that affordably. And of course, you can tie that back to the question of inflation as well, because this is very much part of the reason why we probably saw that surge in some of the price pressures, especially heading into the latter part of this year, very much driven by those higher energy costs. And so if we're seeing a bit of a climb down there, certainly not a bad piece of news for consumers as they head into the holidays here.
Christine, thank you so much for joining us this morning. That's Bloomberg's Christine Aquino. Let's continue the market conversation. We're joined now by Tancredi Cordero, CEO of the boutique investment advisory firm Kuros Associates. Thank you so much for joining us on this Christmas Eve. We certainly appreciate it. I want to pick up where Christine left off on the European gas crisis, because again, we're seeing some of those prices plunge. But I wonder for you, how big of a threat in your mind is this for the European economy and European growth?
Well, thank you for having me, first of all. I don't think it's necessarily a big threat long term. Obviously, we're also in the middle of the, or at least at the start of the winter, and seasonality prices, price movements are obviously impacting negatively the headline cost of gas. But I think it's definitely a short-term problem, and I think that it will not impact long-term the economy here in Europe.
What does it mean, though, for Europe when we're at a point where already the central bank holds the majority of European bonds, and an ECB that is looking to start to tiptoe into tapering next year? What does that mean for our outlook in terms of European sovereign bonds?
Of course, I mean, the ECB will likely follow the Fed, but I don't think it's going to be as convinced as the Fed will be in terms of tapering and hiking. I think they will be much more dovish than their American counterparts. So I think that certainly, fixed income is not the place to be for 2022 in general, but more so for, I think, short-term inflation expectations and also certainly for monetary policy, as you pointed out. But I think in general, it will be much better to shy away from the asset class as a whole. Not really because of concern of monetary policy, but more so because it's definitely a bogey asset class as it is right now.
I mean, does it still have, in terms of bonds, and especially U.S. Treasuries, does it still have that defensive, diversifying job that it has historically in portfolios?
I think so. In a general, global asset allocation, it definitely has diversifying power. I think tips are definitely more interesting than plain treasuries. If we look at, the American market, so having an inflation hedge could definitely, help in 2022, at least in the first half. However, it's not a great risk-reward profile if we look at it. And in a year when, we're still in the middle of a recovery from COVID and, from the hit that 2020 brought to the real economy, equities are definitely a much better deal for investors at the moment.
Okay, Tancredi, I definitely want to get more of your thoughts on the outlook. So you're going to stick around with us as Tancredi Cordero, CEO of Kuros Associates, stays with us. And up next, as we said, we're going to discuss the 22 outlook. But if you have any questions of your own for our guests, if you want to see his crystal ball into next year, what you want to know, it's IB plus TV Go on your terminal. This is Bloomberg.
The Omicron variant.
Omicron is increasingly in the rearview mirror.
This is going to be very mild.
It is still much more transmissible.
We don't think Omicron is that big of an issue.
People can't go to work if they have the virus.
It's already been discounted into the market.
A lot of the market indicators.
I'd be cautious.
It's like more red flags than most of my ex-boyfriends.
I'm actually quite comfortable with what we're seeing in Omicron.
Some of these vaccines are proving to be pretty good against this version.
It's going to have an economic impact, whether or not it's deadly.
It's time to re-rest.
There's going to be a bit of a roller coaster ride.
More red flags than an ex-boyfriend. That was Bloomberg TV guest on risk to markets from Omicron. Tancredi Cordero, CEO of Kuros Associates, is still with us. Tancredi, I was really struck by one thing you wrote in your note, that markets are ever more style-driven. How do we assess where the styles are going, considering that often growth versus value has to do with where we are in the cycle, but it has been so difficult to really discern at what stage we're at?
Absolutely. So if we look at earlier this month, about 1,400 stocks traded on US exchanges below their 52 weeks all-time high levels. And, if we look even more closely within the NASDAQ composite, we had about 1,300 stocks or so that were about 50% or more of their peaks. So this year has been all about, re-rotation from growth to cyclicals and to value. It's almost like the market is jumping on the value train and then hopping on the growth train, and probably this will continue. If anything, at the end of 2020, we were talking about, a bubble bursting in tech, and, a bubble did burst below the surface, but we didn't notice because the market continued to rally. Why? Because, the market has been driven by large caps, big tech, and cyclicals. But below the surface, small caps, mid caps, high growth, loss-making stocks were tumbling. And so this could actually be a good place to look for winners for 2022. Although we think that for the next, what we call the Santa rally, I suppose, whether it comes or not, big caps and 2021 winners will continue to drive returns. So, yeah.
Well, I mean, it's kind of interesting because if you look at perhaps some of the big tech stocks, you say, okay, these valuations are so high, it's difficult. You kind of have to hold your nose and buy them. How do you work through those two impulses of saying, okay, perhaps this market is exuberant, but then again, if you're not involved in it, you miss out on the bulk of returns?
Of course, the market was indeed exuberant at the end of last year as we were getting out of 2020. But I think, as I just said, a lot of companies, a lot of stocks have been repriced throughout the year. And, you point out at some stocks like, in the large cap space, Tesla or other smaller caps, like, I don't know, the more sort of Spotify type or those type of companies. Throughout the year, although their stock price has been tumbling down, their earnings per share and their fundamentals were going up and were improving. So they're still extremely expensive if we benchmark them to, historic, market valuations. But I think now it's a much more, safe. It's much more safe to allocate to those, companies and stocks than it was just a year before.
All right, Tancredi, we really appreciate your insight and really appreciate you joining us on Christmas Eve. Happy holidays to you and your family. That's Tancredi Cordero, CEO of the boutique investment advisory, Kuros Associates. Now, coming up, we look at Omicron's impact on aviation this Christmas as United and Delta Airlines cancel over 200 flights. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition on TV and radio. I'm Danny Berger in London. Now, let's get your look at which markets are open or are closed today. Obviously, Christmas Eve means that many are closed. That includes the U.S., where U.S. Treasuries, Treasury futures, cash equities, stock futures, and crypto futures are closed. But Bitcoin up and trading, back up above $51,000, I should say. And in the U.K., stocks close early at 12:30 local, off just in time for lunch. Brent closes at 1 p.m. Gilts and gilt futures close at 3:30 UK time. France will also close early, just after 1 p.m. UK time. For Turkey, you can trade that all day long. It's normal trading there. And for both European and UK gas markets, they close at 3:30 p.m. UK time, which are currently in the midst of the biggest three-day decline on record. Now let's shift gears to the U.S., where United and Delta Airlines are expected to cancel 200 Christmas Eve flights. That's because of staff shortages linked to COVID. It's a blow to the carriers still trying to recover from the pandemic, with the holidays one of the busiest times for travel. Let's bring in Bloomberg's Laura Wright for more on this. Laura, this has to be a blow for people hoping to travel today.
Really disappointing for travelers hoping to see family or friends this holiday season. For United, the primary reason is COVID cases amongst their staff. They can't pull enough crew members together. For Delta, it's COVID as well as the weather. This is against a backdrop of a broad-based recovery in US domestic travel. TSA data for this week is almost back at pre-pandemic levels. I've been looking at OAG data on seat capacity comparing this week to the same week in 2019, and that shows a clear divergence between US carriers and their European counterparts. The US airlines have been able to benefit from that intrastate travel. For example, American Airlines down just 8% over that period, while British Airways down 31%.
Laura, how does that compare to Europe and some of the key travel destinations there?
Europe is far from a recovery, and referring back to the OAG data on seat capacity, the dominant theme is double-digit declines. Now, Greece is the clear outperformer in that basket of countries, down just 3% over that period. The United Kingdom, the group laggard, down 30%. The UK is still facing travel bans from France and Germany, which also explains their underperformance. That said, year to date, this was the best week for seat capacity from that basket, but there is the risk of more downside ahead due to negative news flow surrounding the virus.
What is the market currently pricing in, and how has it reacted to this turbulence?
Airline stocks have been sensitive about virus news. A month ago, when we learned of the discovery of Omicron, that led to a sell-off in the sector. Yesterday, after the results of that preliminary study indicating that Omicron cases are less severe, we saw a rally. Today, the price action is mixed within the sector. I spoke to John Strickland, director at JLS, yesterday. He told me, crucially, Christmas is the time when families come together and think about where they want to go on their summer vacation. Airlines rely on those forward bookings for planning and to arrange their staff rotas. We've seen cancellations so far already for pre-existing bookings. Ultimately, the airline industry are terrified that they're going to be facing a third summer of disruption. Unbelievable, Danny. Who thought we would be in this position at the beginning of the pandemic?
I know we really did not think we'd be here, but here's fingers crossed, hoping that at least next year it won't be the same. Laura, great reporting. Thanks as always. That's Bloomberg's Laura Wright, who I should say has the best Christmas tree that has graced our screens all day. Coming up, we're going to look at Brexit's impact on labor and how the jobs market has changed. This is Bloomberg. Santa rally, U.S. stocks hit an all-time high on optimism Omicron won't hamper the recovery. Market sits steady amid thin trading. The spike in COVID cases upends travel plans. United and Delta Airlines cancel around 200 Christmas Eve flights due to personnel shortages. Plus, gas prices plunge as more ships carrying U.S. LNG race to the continent to offset Russia supplies. Well, happy Friday, happy Christmas Eve. Good morning and welcome to Bloomberg Surveillance Early Edition on TV and radio. I'm Danny Berger in London, standing in for Francine Lacqua. Let's get your check-in on markets on this day before the holidays. I should point out that volumes are extremely light, so it's hard to read too much into what we're seeing just in terms of how light that volume is. We're in some cases 95% off of our normal volume of the 20-day average. That's the Euro Stoxx 50, but the DAX is closed, so that lends itself to why. We're looking at a flat Euro Stoxx 600 versus a FTSE 100 that is able to climb. We have a flat pound, so that's not too much of a headwind to the FTSE 100 index. There are some tinges of risk off. We're looking at Brent crude down about 0.7%. But of course, this is off the back of a stronger day yesterday and U.S. stocks that ended the day at all-time highs, and Brent crude itself climbed 2%. So on this lighter trading day, perhaps not too unusual that we're taking a bit of a breather. Let me show you what it looks like among other asset classes as well. On your GMM screen, and on the GMM screen, this is your global macro markets. The one market that is really moving, not taking the day off, is natural gas. That's in the commodities column there. UK Nat Gas and Dutch front month futures, those are the two top ones for our radio listening audience. Both of them are down 21%, down 40% from the all-time highs. It's starting to plunge because more supply is coming into the market thanks to U.S. LNG shippers who've diverted their path to Asia, instead going to Europe, trying to fill some of the gap left by the lack of Russia supply. Elsewhere, I do want to point out Turkey, which is online trading all day. The lira falling today after 4 days of gains after Erdogan's government stepping into the market to try to curb some of the plunge in that currency. Let's switch gears and focus on the UK, and it's been almost a year since the UK technically severed ties with the EU. Today, we're looking at the impact of Brexit on the labor market. Let's bring in our UK economy reporter, Lizzie Burden. So, Lizzie, how over the past year has Brexit affected jobs?
Well, Brexit's exacerbated the labour supply crunch in the UK. About 200,000 EU nationals left in 2020. And that's led to staff shortages in industries that were especially reliant on EU labour, like retail. And that's led to shortages on shelves. You also had that fuel crisis over the summer. You'll remember the cars snaked round petrol stations. And that was because of the trucker shortage, which again isn't all about Brexit, but definitely was caused partly by it. Now, in those industries where you had recruitment issues, employers had to dangle bigger salaries to lure workers, which meant they had to hike prices to cover the wage bill. So adding to the Bank of England's inflation headache and squeezing household finances. And as we head into 2022, along with this drip, drip, drip of stories about the government not following its own rules, it's the cost of living crisis that's likely to bite Boris Johnson, which is ironic given Brexit has been such a big part of what this government's about, that it's partly contributed to the cost of living crisis.
And of course, all of this has been happening as employers, governments also dealing with COVID.
Yeah, and COVID a big reason why so many of those EU nationals left in 2020 before the UK left the single market and customs union. They didn't want to be stuck here in the pandemic or in the aftermath recession. And then when visa restrictions were tightened, they found the drawbridge closed and it's more difficult to come back. But interesting to compare that 200,000 figure, because 375,000 people became economically inactive in the period. That's not employed or not looking for work. And the reasons were that people were staying students for longer, they were declaring themselves retired or long-term sick. So actually, COVID had a bigger impact on the workforce than Brexit.
Really interesting, Lizzie. And I should say all week you've been doing a fantastic job giving us the year in review when it comes to the UK's exit. Lizzie, thanks so much. That's our UK reporter, Lizzie Burden. Let's dig into this more. We're joined now by Nicholas Makkel, CEO of Luxembourg for Finance. Nicholas, thanks so much for joining us on this Christmas Eve. I was talking to Ernst & Young's Sally Jones earlier today, who said that this post-Brexit relocation from the UK into the continent, some of it was put on hold due to the pandemic, and she expects that we should see an uptick in that once the virus starts to subside. Are you expecting the same thing?
Exactly. Yes, I think that the figures that have been touted by some people in the city that apparently 7,000 jobs only have been relocated from the UK to London is only a partial view of the situation. First of all, because the figure compiled by EY gives only firms that have more than 200 employees in London. So that's one sector, one segment of the market that isn't even covered. But then, as you rightly say, I think that COVID has put a hold on some of the relocations, but now you have, after January 1st last year, the regulators, European and national regulators in the EU that have been pressing financial institutions to relocate stuff according to the activities that they intended to do within the EU. And that is a process that will continue. Obviously, this will also have to be seen over time, because what you are looking at is not only the relocations of current business in London, but also future business relocations from Asian firms, US firms, or firms from anywhere else around the world that will look at expanding into the European market and will look at the European map in a very different way. And they will not put those people in the UK. So it's a question of relocations, losing people and losing opportunities.
What are the specialisms that perhaps once were in London, that were once the hub, that London was once the hub of, rather, that will now see shifted to Europe?
So it's very interesting. London was, of course, as everybody knows, a very unique financial center, and still is. I shouldn't actually use the past tense. It still is and will always be, because it has a scale that nobody else can match. London was not only global in a geographic sense, but also universal in the areas it covered. What you have seen is the specialisms of the different financial centers in the EU that attracted business accordingly. Frankfurt and Paris for investment banking and trading activities, as did Amsterdam in terms of market infrastructure, Dublin and Luxembourg for the investment fund part, insurance as well, Luxembourg also for wealth management, with major US banks relocating their EU hub there. Payments also, Luxembourg, Amsterdam, Dublin. So each of the financial centers that received some of these relocations was seen as ideally positioned to support that particular activity.
beyond just competition with Europe and maybe, as you're saying, some of those specialisms losing out to Europe, to what degree does this also weaken London's position as a financial hub versus the U.S. versus New York City?
So, well, obviously, London was this unique financial center I just described because it was also a bridge into the EU, in particular for US financial institutions, investment banking in particular. And that will now not be able to access from London into the EU. In fact, they can access at the present time better from the US. So that is why some of the firms are considering relocating some activities to New York. And then you add to it a number of other factors due to British politics and immigration policies and so on. Probably firms are considering that they are better off relocating some of those activities to New York or other hubs in the US than keeping it in the UK.
The FT also today, Nicholas, has a story out talking about Brussels' planned cross-border banking curb, saying that they're essentially trying to narrow some of the scope. Of course, this is something that might not come as welcome news to many in the UK. How much has this amplified tensions looking at these specific issues when it comes to cross-border regulation?
Well, I think it's quite clear. Brexit means Brexit, as various British governments have said since 2016, and it has consequences. And one of the consequences is that if you are located in a third country and not part of the EU, you cannot directly do business in the EU unless, well, we have equivalence regimes and so on, but the UK doesn't benefit from them anymore. Why is that? Because of the toxicity of the political dialogue between the two sides. I think it would be very welcome if we could move from trading sound bites between the UK and the EU to actually discuss in a very pragmatic way how we can build a mature future relationship. And that will allow our financial institutions, whether they are banks or asset managers or even insurers, to do business across the channel. And that is exactly, I think, what our economies need, because we need capital to be moving from where it is to where it actually is needed if we really want to come out of this crisis, build a strong recovery. And then also, if we look at the needs of this world in terms of sustainable finance and building forward better, that is exactly what we should be doing.
So walking the walk, not just talking the talk. Nicholas, so great to have you on the program this morning. Happy holidays to you and your family. That's Nicholas Makel, CEO of Luxembourg for Finance. Now, coming up, European natural gas prices plunge as the U.S. sends shipments of LNG to help offset lower flows from Russia. We've got that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition on TV and radio. I'm Danny Berger in London. European natural gas prices are plunging again today. That's after this year's stellar rally attracted U.S. shipments of LNG that will help offset lower flows from Russia. Ship tracking data compiled by Bloomberg show that at least 15 vessels heading to Europe, again, having been diverted. Let's bring in Bloomberg's European gas and energy team leader, Isis Almeida. So, Isis, we're seeing natural gas prices plunging 20% plus some today yet again. Does it seem like the market is pricing in that this will be enough to plug some of the gap left by Russia?
There's a lot going on today. I'm not really sure I would say that it's going to be enough to plug the gap. It will be enough for January, I think. I think like all the way to the first week of January, and we're going to have enough gas. And, you know, as all these ships arrive, does that mean that we're going to have enough for the rest of the year? I don't think so. I would say absolutely not. But it's definitely market pricing in that. And also we had so much risk during the year, right? Prices went up so much. And, you know, what you see is the market is really thin. a lot of traders are just looking at this and saying, you know what, I'm just going to close my positions before the holidays, before the end of the year, before I go off, so I don't have to worry about this.
That's totally fair. And I mean, maybe that perhaps also help explain some of the more far out futures markets, 2023, 2024. Those are finally starting to fall as well. They had been held up. Would you describe the same phenomenon for those futures as well? Or is there some hope that some of these structural issues might be solved going into the future?
No, I actually think when you look at how much the forward contracts have gone down, they've gone down a little bit, but they haven't gone down as much as the front month contracts. So the spot is looking at LNG and saying, okay, it's going to be fine. I have enough LNG here. But when you look at the forwards, when you look at the summer, the prices have more than doubled the summer prices have more than doubled over the past month, and they have also increased over the past week. At some point this week, they exceeded 100 euros. Which was a record high, and that's telling you that this crunch is going to last. We may have some LNG coming now, and that's bringing some short-term relief, but, this isn't going to solve the problem. We're still going to need gas to fuel storages in the summer, and gas is going to be expensive even when it's hot.
Given that Putin yesterday, Isis, in his annual press conference, basically said, okay, look, it's the fault of the clients in Europe for not booking the gas. Does that mean we count out Russia at this point for helping to provide any more supply to the market?
Yeah, I think that he didn't, what he's saying is partially true. The European clients have reached their limits on their long-term supply agreements. But on the other hand, Russia isn't selling spot gas either. So in normal situations, normally European customers can go on the Gazprom export, platform, and they can buy spot gas, and they haven't been offering that. So yes, there's in some points, it's true the European customers have hit their limits on long-term contracts, but there's no spot gas to be bought. I don't think Putin gave any indication that he intends to flow any more gas in his press conference yesterday, and I think Russia has been very adamant that it really wants to see that Nord Stream 2 pipeline approved before it flows any more gas to Europe.
Isis, thank you so much for the update. We really appreciate it. Isis Almeida there, our European gas and energy team leader. Now let's get to the Bloomberg Business Flash. Here's Angel Feliciano. Good morning, Angel.
Hey, Danny. Getting home for Christmas just got a little bit harder. United and Delta have canceled around 200 Christmas Eve flights. United said in an email that a jump in Omicron cases is affecting the availability of crew. Delta blamed that and the potential for bad weather. Bitcoin has jumped to about $51,000, touching the highest level in more than 2 weeks. The largest cryptocurrency is benefiting from a return in risk appetite. The digital coin is up around 76% so far this year. It's on course for its third year of gains. Morgan Stanley says staff who have to be in the office in the first 2 weeks of January will have to wear masks when not at their desk. They'll also be required to limit large meetings. It applies to all locations, even those where everyone is fully vaccinated. It comes as other banks, including Citi and Jefferies, are revising their return to office plans. That's your Bloomberg Business Flash. Danny.
Angel, thanks so much. Angel Feliciano there. And coming up, sustainable debt financing has hit a record high this year. We look back on a pivotal year in the fight against climate change. That's all next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition on TV and radio. I'm Danny Berger in London. Now, this year is likely to be remembered as something of a turning point in the fight against climate change. One of the highlights was the COP26 summit in November. Sustainable debt also took off, with companies, banks, and governments issuing over $1 trillion in green securities for the first time. The planet, however, continues to warm up. Just think back to recent natural disasters in the U.S. and the Philippines. The reality is the world is likely to remain dependent on fossil fuels for some time. Joining us now to work through all of this is Bloomberg Green reporter Akshat Rathi. Akshat, thanks so much for joining us. So, sustainable debt topping $1 trillion. What's driving that?
It's both physics and politics. As you said, the planet is getting warmer and it's going to continue to get warmer, which means climate impacts are here and they are being felt both by businesses but also governments. And as we saw at COP26, governments have given a clear signal that they are committed to acting on climate change, even if those commitments haven't yet added up to what is needed to try and tackle the worst impacts. And one way in which this signal can be interpreted by businesses is to try and move their businesses towards a greener future. And that's one reason why we see a record debt issuance here in 2021. And it's only going to grow as we've talked to analysts. But we should also recognize that in anything that looks like an exponential growth, there is a lot of hype, and behind that hype, there is likely room for greenwashing. And so it's really important that as we look at these figures, that we ensure that the money is actually going for the purposes that they say it is.
Akshat, how has the global energy mix evolved over the past year, especially when it comes to renewables?
So we are currently in a gas crunch, especially here in Europe, but earlier the gas crunch existed across the world. And it sort of reminds us that we are dependent on fossil fuels. But the trend on renewable energy has been spectacular, where we've seen a huge amount of growth in both solar and wind. And that's driven now purely by economics, because majority of the global market now, more than 50% of all countries, is where renewables, both solar and wind, are cheaper than being able to run existing coal power plants or even gas power plants, especially at the prices that we are seeing today, but even at the lower prices that existed a year ago.
And also another trend we've witnessed, and especially anyone who follows Elon Musk on Twitter, is that EV sales have also grown fast globally. What regions have been driving that, Akshat?
So it's actually no longer just an Asian story, which used to be the case a few years ago. Now it's really quite global. We are seeing shares of electric vehicles go up across Americas and Europe and, of course, Asia. And if anything, Europe has really taken the lead because of the support that it has got from the European Union and its Green Deal, reaching almost 20%. And as we've spoken to analysts, it's going to continue to rise because battery prices continue to fall. Despite the inflationary pressures that we've seen on certain metals and supply chain problems, the trend has slowed down, but battery prices continue to fall, which means electric cars become more and more viable alternative to fossil fuel vehicles.
Akshat, really comprehensive reporting there. We appreciate it. That's Bloomberg Green's Akshat Rathi. Now, as we close out the hour, we are looking at relatively steady markets. Again, volumes are very low. We have a lot of markets closed. Germany is closed. U.S. futures markets are closed. So there's not a lot to take your cues from. One market that we have seen move pretty significantly is the natural gas market. That one continues to plunge for its third day. It's on track for its biggest three-day plunge on record. That's if you look at Dutch front month futures. That is down 20% so far this morning. Again, it's because LNG shipments being diverted going to Europe because those prices are so high. So you can see that there, natural gas down some 20%. We're also looking at a Turkish lira that is falling after rallying for most days. Well, up next, it's Bloomberg Markets. Tom McKenzie is going to take over from here. Merry Christmas, everyone. This is Bloomberg.